Trade school's in session. Let's bring in BondClick CEO Chris White. Chris, let's talk about what kind of impact this might have on the corporate bond market.
Well, thanks for having me on. I think that that's actually something that the Fed is going to have to seriously consider when they talk about implementing their policies for raising rates. They've already started tapering when it comes to direct bond purchases. They stopped buying corporate bonds and actually sold their positions out in 2021. And they've really tapered when it comes to buying treasury bonds and mortgage bonds. And what this effectively does is it starts to change the value of corporate securities in the marketplace as people anticipate that the real interest rate environment is going to be higher, and therefore current corporate bond holdings lose a lot of their value because they're paying such low yields.
Chris, it's Karen. Let me ask you something. If we get a really hot number tomorrow, do you think the curve will flatten more or possibly invert, or do you think the whole curve will move up, the slope will stay the same? How do you think this plays out if we get a hot number?
Look, I think that anytime we talk about moves that are happening in the marketplace and we're in like close to mid-December, I think everybody needs to relax in terms of what it means for the broader future of the marketplace. Things get very, very choppy in December because traders are on vacation. People are trying to book profits in this calendar year so they can get paid. So I wouldn't overreact to any moves that happen on the yield curve coming in the next few days. What I would look for is in the beginning of Q1, what's the trading activity? Are you seeing a lot of movement out of longer dated maturities into shorter dated maturities, which would really steepen the yield curve? Because that would be an affirmation that people think that rates are going to be raised possibly pretty aggressively, and they want to make sure that they've got powder dry so that they're going to be able to buy those bonds that have juicier yields in the future.
Hey, Chris, it's Tim. Thanks for joining us. I'm going to change gears a little bit because you're also a credit guy. 2 weeks ago, we had high yield spreads at 9 to 12-month highs, or wides, I should say. And while I don't think we're anywhere near a credit problem right now, ultimately, we also talked about scenarios from 2 years ago. Guy brought up the Fed policy and whatnot. 2 years ago, we were talking about that large kind of tranche of BBB minus that was, on the edge. At what point do you see credit becoming an issue? And did you see any of that weakness, at least in some of the lower grade stuff a couple weeks ago?
Well, we've had a year where junk bonds have had a tremendous year in 2021. With tons of issuance, and also they've just improved in value. So if you see a little pullback, that's only natural here. We've seen BB spreads that at levels that we've never seen before. But actually, your question's a great one because the Fed is in a really precarious position here because something we're not talking about is the wall of debt that is maturing from not only U.S. corporations, but there's about $72 billion in emerging market debt that's maturing in 2022. If the overall global interest rate environment raises or rises too quickly, a lot of these junk bond corporations that have, or junk bond emerging market institutions that need to retire their debt in 2022, they may not be able to refinance at favorable interest rates, which could start to raise the default rates. How this impacts the U.S. markets is what we've seen is in this sort of area where yields have been really hard to capture for asset managers and pension funds, they've had to buy emerging market debt in order to sort of hit their yield bogeys or their performance bogeys in fixed income. And you all remember like what started to happen when Chinese real estate companies started defaulting. We're finding out that lots of American asset managers had significant positions. So these are the things that the Fed has to consider. It's not just what's going to happen in the domestic markets. They've got to really think about just how broad investing activity has gone outside of the United States and how their interest rate policies are going to impact those companies as well.
Yeah, no, definitely throwing a very large rock into the pond. There'll be a lot of ripples. Chris, thank you. That was great. I appreciate that very much. Let's trade this, Dan. I mean, what are your thoughts coming out of that? When you think about new issuance, have corporates assembled enough dry powder for now, or will they sense the window closing?
Yeah, no, I think that's a great point. I mean, corporate balance sheets are obviously in a really good spot here, but I'll just say this, Carl, you're new around here. I'm easily the dumbest guy on this panel on any given night, but I'll just tell you this, man. Steve Leisman categorized the economy as rocking and rolling, but listen, we threw like $5 trillion at this pandemic, right? And so why are those balance sheets the way they are, both business and consumer? If you look at GDP expectations for next year, when I hear about margins, corporate margins where they are, they seem like it's a peak sort of scenario, especially when expectations for rates are higher and all that debt that we have right now. I don't think rates are ever going meaningfully higher, but I also think growth is going to disappoint next year. If you think about Goldman Sachs just lowered their 2022 GDP growth below 4%. You know what we were averaging pre-pandemic after the financial crisis? About 2.2%. In Q3 and Q4, they're expecting GDP to have a two handle. That's where we're going back. And we are choking on debt, both corporate and sovereign. So I just think growth is going to disappoint. And I just think it's going to be a tough environment for stocks when you consider the performance that we have had over the last 2 years and how much capital it took from both the Fed and obviously the Treasury and Congress just to get here.